bottom left-hand index box. You look at some of these trailing one-year index performance, and extremely strong, right? On the equity side of things, doesn't really matter where you were up 50+%. You held, a lot of small cap equities. You were up closer to almost even 100%. I mean, you really just don't see numbers like this very often ever in a trailing one-year period for actual index performance. So we'll take a look at how the trust is done and some of their one-year numbers, but we've got some pretty impressive trailing one-year numbers for the trust level as well. I can go more into capital markets if there's any questions from the trustees, or I can jump into plan performance.
Question, you're watching the pipeline ransomware attacks that are happening and causing some stir out there in the economy. There's always going to be copycats. Do we see this as being a short-term risk or a long-term risk for the economic recovery?
Yeah, I mean, I think that everybody has been aware of kind of these cyber attacks for a long time now. And I think that, what you're exhibiting, particularly in some of the energy companies, some of the pipeline companies, is a real vulnerability there, and how that can directly affect supply and demand with respect to oil. So I would assume, again, this is a little out of my element, but I would say that if you just read earnings reports from companies across all sectors and all industries, you are seeing a notable pickup, not just in the past couple months, but really over the past probably 5, 6, 7 years with respect to beefing up their cybersecurity. So I don't see this as necessarily something that's probably a huge risk to most industries. But some of these industries like oil and gas, for example, I think that there is certainly a potential for this to be a risk going forward. And I think it's one where largely any company in any industry or sector is making sure that they're trying to have their bases covered. But again, these things can happen to well-established companies. So everybody's getting smarter about this. I think it'll be kind of a race for most companies to make sure they can stay ahead of the curve with respect to any of these attacks. Any other questions? Okay, if none, I'm going to move a few pages ahead. Here we can see where the trust sat at the end of Q1. So if we kind of look at that bottom schedule of investable assets, kind of gives us the first 3 months in a very clean snapshot, up about 2.7% net of fees. That kind of mirrored a movement from $36.8 million to about $37.9 million. So a gain loss of right at $1 million with minimal cash outflows in the first quarter. So pretty strong performance again to start the year off. A really great Q1 number. I did want to mention that while this isn't a final number, I did want to provide you, the trustees, with an estimate of where the trust sat at the end of last week, which was the most current numbers I had, and estimated up about 7.5% for the year through last Friday. So that's kind of shows you just how strong the market has been even since the print of this. And that's just including April, which was an extremely strong month, and month to date in May, which has been more flat through yesterday and today, particularly as some sell-off has happened in the last couple of days. So really that's indicative of just how strong April was. So the trust probably is up closer to about 7.5% as of yesterday. Just wanted to give you all kind of a quick update on that. But some really strong performance numbers here. Asset allocation sits within target ranges. We have seen, a little bit of a drift, if you will, here with the trust being a bit overweight equities, a bit underweight fixed income due to that market movement that I told you about kind of in the capital market section about how equities have continued to run up. Fixed income has continued to kind of drag a little bit with yields rising. Not so much that I think necessarily requires any kind of rebalancing activity right now. We certainly haven't breached any bands in any of our policy bands. And I would assume with some of the pullback that we've had in the last couple of days that these differences versus target are probably pretty similar to what you're seeing here, if not maybe a little bit minimized. But I will certainly continue to report back if there needs to be any rebalancing activity if we do start to approach policy bands. But at this time, not necessarily seeing a large rationale for doing so. I'm going to move a few pages further forward here, and we can take a look at the performance versus some peers. So again, really strong peer performance. This is gross of fees. We'll look at net of fees in a second, but when we compare to peers, we have to do it on a gross of fees basis. We don't have, it's borderline impossible to get visibility into all peers' investment related fees. So most peer comparisons are on a gross of fees basis. But you can see here for the year to date or quarter to date, which for this time period are the same, just the 3 months to start the year. I'm not sure if my cursor pops up on the screen or not, but right here you can see ranking in the 31st percentile, which is really good. We want to try to be above median on all time periods if possible. What I would say is probably the most eye-popping number that you'll see is here ranking in the top decile over the trailing year. So the trust has done extremely well during this recovery period due to a number of things. One, it's had some really strong alpha versus our policy benchmark. So that's just a fancy way of saying this excess return. So you can see the trust was up 41%. Our benchmark was up 34%. So almost 700 basis points or 7% outperformance versus the benchmark. So that's due to a couple things. One, we had really good outperformance by basically the whole suite of underlying investment managers. They've done that collection of managers has done extremely well. The other thing that factors into that excess return number is we did have, if you recall, after the initial March sell-off, we had a special meeting to contemplate rebalancing the trust. In hindsight, we couldn't have picked a better time to do that. We rebalanced right at kind of the low point when policy bands were breached. Again, that's why we have policy bands, is to kind of force us to make some risk decisions right when it is the most difficult to do so. And so those policy bands proved very fruitful as we rebalanced back into some sold off equities, and right before the initial recovery had started, that also contributes somewhat to that 6.98% outperformance versus the benchmark. So up 41% gross of fees for the trailing 1 year period. If we look at it net of fees here on a couple pages further forward, that's about 40.6% or just shy of 41% for the trailing year. That has materialized into some really strong trailing period performance as well. So you can see here well above our return target over all trailing time periods. Over the 10-year period, the trust has annualized about 7.6% performance net of fees. So really, really strong here. That is a lot to do with some of the great positioning that we've all collectively agreed upon for this trust over the past decade. So kudos to everybody on this committee and for some of the decisions we've made. It has really bared a lot of fruit, and you could even see that in the last meeting when we discussed the funded status jumping notably. And we're on track for another good year so far, assuming we don't have any huge market hiccups in the back half of the year. Again, mentioning that we're up about 7.5% or so if we were going to look at these numbers through about Friday. So if we're kind of looking down in some of the subcomposites, where did a lot of that come from? Well, as you might imagine, most of that came from our equity exposure. So that's really these first three sections here under the total fund. Total equity, you could see on a one-year basis was up 62% net of fees. Domestic equity accounted for 66% of that. International equity accounted for 59% of that, 56% of that. Both of them, I think this is the kind of the thing that I like to take a look at. We saw really good manager outperformance in both composites. We notably saw really strong outperformance from our fixed income managers. So you can see that here in the fixed income composite. We continued to see really strong manager outperformance over the 1 year for the real return composite, and we continued to see notable outperformance from the GTAA composite. So all, five of our main sub-asset class composites, domestic equity, international equity, fixed income, real return, and GTAA, all outperformed their respective benchmarks by somewhere between 400 and 1,000 basis points. So again, you can't count on this kind of thing all the time, but it couldn't have happened at a better time for the trust. And I think that you all should be very proud of some of the manager selection that you've all been a part of over the years. And that's translated here in these performance figures. If we kind of draw it back and look a little bit more on the quarter to date basis, still really strong outperformance across the board on all composites, all of them outperforming their respective benchmarks. Not by as much as we're seeing on the trailing 1 year period, which is to be expected over just a 3-month period, but still outperformance across the board, all across these different 5 subcomposites. Maybe I'll hit on a couple high points, couple low points for both the quarter to date and the trailing 1 year period for the select managers. I think probably the most obvious high point is Dodge & Cox. They were up about 5% over their benchmark. So they had a 15% return versus an 11% return, about 4.6% for the year-to-date period. They were up just shy of 20% over the benchmark for the trailing 1 year. You can see those peer rankings there, just really fantastic value manager that caught that whipsaw that we saw from growth into value at a really great time, and not only provided us with some really good value exposure, as value has kind of outpaced its growth counterparts in the trailing really 5 or 6 months, but has well exceeded the benchmark in doing so. So you can see that here. Harbor Cap is one that had a more difficult Q1, but a really strong trailing 1 year. So, you kind of have to take that with a little bit of a grain of salt. They were well outpacing the benchmark. They were actually up over 10% over the benchmark for the trailing 1 year before Q1 happened. It's been a more difficult situation to navigate for some managers that have more tech exposure. If you've been following the news the last couple of days, that's really what's been driving some of the sell-off here early this week is tech-related stocks. So obviously we've got more of that exposure in our large cap growth manager, which is Harbor Cap. than we're going to have in other segments. So they've had a little bit more difficult time navigating that this year, but doesn't mean they're not a great manager. They're while the ranks have not been favorable this year, their long-term ranks still remain extremely favorable, and we still have a lot of confidence in their ability to navigate. I will say you can see very similar trends from both of our international equity managers. So LSV being the value manager, and American Funds being the growth manager. Both of them providing some strong alpha versus their benchmarks over the trailing 1 year. LSV doing it also in the year-to-date period, and American Funds essentially keeping pace or a little bit of underperformance versus the benchmark in the year-to-date period, but nothing notable. Again, these managers continue to have some really strong long-term peer rankings as well. And finally, on the next page, recall, Vanguard is our passive bond manager, so they're mainly just tasked in tracking the benchmark. But Double Line, if you recall, they were one of the managers. They hold about 2/3 of the allocation or so of our fixed income portfolio. They have had another really strong start to the year. Obviously, on an absolute basis, being negative as yields have gone up, but they've navigated that really well and are outperforming the benchmark. Notably, you can see here over the trailing 1 year period, up about 600 basis points over the benchmark. So Double Line's while Vanguard Total Bond is really giving us that kind of safe, and I say safe in relative terms, but really is going to give us more of that government debt, high quality issuance exposure. Double Line's really the one giving us that higher yielding, a little bit more core plus sectors, if you will. So some emerging market debt, a little bit more high yield, things that are earning yields in excess of what the Bloomberg US Ag Bond Index is giving us right now in the Vanguard Total Bond. So two different flavors of fixed income. They've done really well in complementing each other, both in the early part of last year in the sell-off and in the post-sell-off recovery. So those have continued to do really well. I think the last two I'll hit on here is you can see in PIMCO inflation response. They are up really strong over the trailing 1 year. Again, that's due to we're starting to see more inflationary pressures build back up in the economy. This is the part of the portfolio that we would hope to see do well in those environments. We are certainly dipping our toes into that environment, if you will. But I do think that's a really big or a very important allocation that the trust has, particularly moving forward. If we were to see runaway inflation or inflation that the Fed does not try to control early on enough, and it kind of jumps up much higher than we've been used to for the past decade, a lot of the instruments in that PIMCO inflation response allocation are going to be the ones that respond to that more favorably, and you have seen them do that over the trailing 1 year. Finally, Pine Bridge below it, kind of our GTA do anything manager. They've got they've got the most tactical freedom of any manager in the book. They've navigated the environment extremely well over the trailing 1 year as well, almost very similar to PIMCO inflation response, up just almost south of 1,000 basis points for the trailing 1 year. So I know I went through a lot there. All good, really good news for the most part, but did want to stop and make sure I had some time to answer any questions that you all had for performance.
Hey, Ian, can you hear me?
Yep.
Okay. It was just interesting to watch you go through all those managers, and we've always had a debate. We've kind of talked about it back and forth over the years of an active versus passive strategy. And in this environment, it definitely seems like the active are producing alpha overall. I mean, way more than the passive managers have been. And, I know we've had some conservative trustees over the years who just want to put in a passive funds and low fees, and but to see the outperformance, I think it's encouraging that we stuck to the strategy.
Yeah, and I think that's why, and you bring up a good point, Bill, and I'll go back here to this initial page, right? So, like, I want to remind everybody that we have passive sleeves in our domestic equity, international equity, and fixed income book. We just use them in a way that we think is most effective. So remember, the domestic equity book is largely passive. We have this Fidelity fund here, this Vanguard fund here in international equity, and this Vanguard fund here in fixed income. So I think in a place where generally active management has struggled, which has been domestic equity, we've been more cautious about using excessive active management. In places where active management has historically been more successful, like international equity and certainly fixed income, that's where we've been more aggressive in using our active allocations. So I really think I would commend everybody on here with I think too often trustees get, I think where you see things go wrong for some funds is where they think that active passive is a binary decision where they have to do active or they have to do passive, and they get lost in that argument. I think the better way to handle that argument is similar to how you all have done it, is to say, okay, where does it historically work best? Let's have active and passive components to each one of these composites, but let's be smart about the weightings that we use. Because if, there was and I don't want to just ring the bell on how well active management has been doing well, because it's not only, it hasn't done well for everybody. Your managers in particular have done really well. But, we had a run there of 4 or 5 years where active management really struggled. It was really difficult, particularly in domestic equity, to outperform the S&P 500 index, for example. And we're starting to see that tide turn a little bit. And usually that does turn, if you look historically across market cycles, when we start to get volatility entering the market again, we start to get these kind of 1, 2, 3 standard deviation events like we had with 2008, like we had with the COVID sell-off, or like we have currently still with some of the inflationary pressures going on. I think that's when you typically see active managers do better. When everything's just going great and everything's trending straight up and there's no risks to the market, that's generally when active management fails to keep up a little bit. So I think that this committee has done a really good job of making sure we've got exposure to both active and passive, but we're doing it smart, and we're making sure that our active managers are worth the fee dollars that we're paying them to do so. I think that certainly translated into the last year's performance. Any other questions on performance? If not, we do have our annual asset allocation review next, which I do have a couple minor recommendations. So I do want to make sure we have some time to get into that.
Not seeing anything, Ian, so I think we can go to that.
Okay, I think that was a go. So let me, and again, there's a lot of information in here. If there's any other questions on any of these additional supplemental pieces, please reach out and ask me always. Asset allocation, we do this every May meeting. This is an annual exercise that we go through, and we dovetail it on the back of our firm, RVK, publishing our capital market assumptions, which is a fancy way of saying our forecasts for asset class return, risk, and correlation for the next 10 to 15 years. We update those every year for that forward look period. And that is what we use as a comprehensive framework to assist clients in thinking about their asset allocation decisions. We publish a 100-page white paper on the process. It's a 3-4 month long process the entire firm goes through. All of us consultants sit in a room and debate these changes rigorously for weeks before we actually come to a conclusion of our firm numbers that we then publish and use in client portfolios or for modeling purposes, as we're going to see today. So if anybody wants some riveting 100-page reading, let me know and I'll pass you along that white paper. But the general theme for capital market assumptions, and it's probably not surprising if you understand kind of how capital market assumptions are built upon, is that we continue to see kind of a downward trend in asset class return forecasts. And why is that? Well, we were kind of at this difficult time where, one, valuations are extremely expensive for equities. The S&P 500 and all the European indices, we continue to see them hit new record highs. It seems like once every couple months. Price to earnings is extremely high right now. And so forward looking, history will tell us when earnings are that high, price to earnings or PE ratios are that high, forward looking returns don't generally look great. It's basically saying that we're paying a lot for a stock that's giving us X earnings. We're having to pay a lot for those stocks right now. Everybody is. That's the good news. But the reality is equities across the board are very expensive. At the same time, we've got starting yields for fixed income that are extremely low. And starting yields are what hinge our there's other factors that go into it, but the forward-looking return for fixed income, there's an old saying, you can't escape the yield. You can't escape the yield that is associated with these fixed income instruments right now. Very low by historical standards. And you have to remember also that the question sometimes is, well, what happens if yields go up? Well, if yields go up, we have a new great starting point, but you take a negative price hit on the way up. And we've seen that this year. So yields have started to trend back up, but you have to know that you're going to take that price hit on the front end of that 10-year period until you can get to a yield that is then going to stabilize, hopefully, and provide that solid level of income going forward. You got to take that price appreciation hit on the way up. So as you can see here on this page, we've lowered pretty notably our assumptions for U.S. equity, international equity, and for fixed income, but also for GTA and diversified inflation strategies, just not as much. And those are really due to two of those main contributing factors that I just mentioned. I won't go into too much detail, but this is some methodology from a high level perspective on how we come up with different asset class assumptions. I think this is probably the best visual for how we come up with our equity assumptions. And again, this isn't the only factor, but from a quantitative perspective, these are some of the building blocks that we look at to say, how can we come up with a return forecast for public equities? Well, it's really made up of 4 different components. Doesn't matter what part of the world you look at. There's a yield component. What's the dividend yield? You have to take into account inflation. You have to think about earnings growth, and then you have to think about any valuation adjustment. So valuation adjustments are really what's hindering these first 2 columns, which are U.S. equity right now. They're extremely expensive versus historical standards. So while earnings growth is still, pretty good by compared to kind of their international counterparts to the right that you'll see there, the valuation hit is a lot bigger that we're estimating right now for U.S. equity just due to those high valuations. And they have much smaller dividend yields than international equities do right now. So because of that, that yield and that valuation component are two of the biggest factors why we've got forward-looking U.S. equity returns notably lower than international equity. Here we just plot valuations, historical valuations, starting points, and we say what was the 10-year return at that point going forward for that starting either PE ratio for equities, which is in the top right, or for yields for bonds in the bottom left. And it just shows the pretty strong relationship, how you like that, getting back to that point for bonds, for instance, in the bottom left, you can't escape your yield. So your starting yield here is on the bottom, and the forward 10-year return that we saw at that time, going all the way back to the mid 1970s, is shown on the left axis. So right now, if we're plotting this, we've got a starting point of basically no yield. Shows you that the forward-looking 10-year return is pretty bleak. Correspondingly, you can see here for equities, when your PE ratio is the higher it gets, the lower its forward-looking 10-year return has historically been. It's not as strong of a relationship as fixed income. Yields are one that are a very strong component in forward-looking estimates for bonds, whereas PE ratios are a semi-strong indicator. There's a lot of other measures that go into it. That's why we look at things like dividend yield and earnings growth, for example. But it still has a pretty strongly negative correlation, and we kind of want to remind people of the starting point we're in right now. High valuations on equities, super low yields on fixed income. So we need to be mindful of those things when we're thinking about our asset allocation going forward, because that really matters in terms of the risk trade-off between different asset classes. So these are the inputs that we put into what's called a mean variance optimization framework. These are our risk return assumptions for the different asset classes that the trust is exposed to. And these are the correlation assumptions, or how those asset classes move with each other historically over time. We weight them a little bit more toward near term, but we run it back for about 20 or 25 years to think about what correlations have done over different regimes. But you can see there kind of how they move together in the modeling framework and their risk return estimates. And what it does is, and maybe I'll come back to this page, but when we put it through the model, it gets us what's called an efficient frontier, which is that green line. And we can then take it plots what the model will say is the best risk return combination of those asset classes, and give you 10 portfolios and say, okay, given the constraints that we're giving it, these constraints right here in red, and these are very kind of similar, not exact, but they're similar to what kind of our policy bands are, to kind of give us a range of we don't want to completely unconstrain it, say 0 to 100, because that's not feasible. We know we have to have some fixed income. We have to have some equities. We can't afford to not have a bit of everything. So we've got some minor constraints over it, and then we say, what are these 10 portfolios that the model gives us? How do we plot our current target, and what minor adjustments might we be able to make to have a better risk-adjusted, forward-looking outcome? And we have to think about a lot of things here. We got to think a lot about what the plan's liquidity needs are, what the funded status is, how much risk the plan can take. And, there's a lot of things that go into this decision-making process. And obviously, another big one is we're trying to do the best we can as a committee and as your consultant to say, we want to try to give ourselves a realistic chance of hitting that your discount rate or your assumed rate of investment return that you've got in your actuarial reports. We don't want to necessarily simply just pick asset allocation that specifically hits that. That's not the goal. But the goal is to build a portfolio that gives us a reasonable chance of hitting that number going forward. That's your chosen long-term investment rate assumption. We certainly want to try to get close to that if we can, while understanding the downside risks associated with doing so. The unfortunate thing that not just you're kind of faced with right now, but every pension plan across the entire US and really across the world, is that while discount rates have come down notably, yours including so, and I think you guys have done a really good job of staying kind of ahead of that curve, or ahead of that trend, if you will. There's still a lot of pension plans that have 7% return targets, and that's not the case with you all. But even so, even anything in the above 5.5 range is still getting harder and harder to hit from a capital markets assumptions perspective. And that's not just using our capital market assumptions. If you look across the entire industry, everybody's capital market assumptions have continued to trend down over the past few years. So we want to think about a prudent way to try to get there while minimizing the downside risk. I think that I've tried to put 3 proposed portfolios. And if you recall, we haven't changed the asset allocation mix for ATU for a couple of years now. So this would be the first time in a couple of years that I'm proposing or recommending a couple changes. I've put 3 changes here. The main themes are slight shifts from U.S. equity to international equity to take advantage of some of those valuation differences that we're seeing. If you recall right now, if you were to buy just a global equity index, for example, the U.S. makes up about 50% of the global equity index. So if you were just going to go full passive global equity and not split it out between domestic and international, you actually would end up with something very similar to the mix shown here in proposed 3, which is a little bit heavier weighting to U.S., but pretty well balanced between the 2. Right now, we've got a mix that is much more heavy U.S. equity than international equity, and it's done really well. It really has. It's done really well over the past 10 years to have that U.S. equity bias. But I think the argument for continuing on that path is getting less and less strong. So I've proposed 3 portfolios here that consider different ranges of implementation into balancing those exposures. Still same overall allocation to equities, still 55% to equities, just some minor rebalancing shifts between them. The second main theme that you'll see here between 1 and 3 is a slight reduction in fixed income for a slight increase to diversified inflation strategies. To me, this is what I personally think is probably the easier decision, is to make some shift from fixed income to diversified inflation strategies, because I think that this is probably one of the biggest risks that's underrepresented in pension plans today, is the potential for inflation to pick up and have negative effects on pension allocations. I would be in favor of minor adjustments from pulling from fixed income and moving that into diversified inflation strategies, or our real return manager. We call them real return in our reports, but we've labeled them DIS here. One of the other reasons why I think that's a easier decision than the U.S. international one is that the diversified inflation strategies, or our real return manager, PIMCO inflation response, it's still holding primarily bonds in that vehicle. So you're not necessarily going, trading out fixed income. You're trading nominal fixed income for more inflation protected fixed income. So there's still both tip. I mean, you're basically trading treasuries for tips is the way I look at it broadly. They're both still, issued by the U.S. government. One just has more of an inflation-sensitive component to it. And again, these aren't huge shifts. We're talking 25 and 10 currently to something maybe like 22 and 13. Or we could pick one in the middle here if people wanted to kind of phase it in a little bit more, or we wouldn't have to do anything if the trustees don't want to make any moves here. But those are the two recommendations that I would make. It does move us up a bit higher on the efficient frontier. And really that's just a way of saying that it doesn't really add much from a risk return perspective ratio, but on an absolute basis, it does give us a little bit higher expected return with a little bit higher expected risk. But when we run it through kind of a Monte Carlo simulation, that's just running it through 10,000 different scenarios with different distribution patterns, and we map all 10,000, and we say, okay, what's the worst case scenario over a 1 year event, and what is the probability of hitting your guys' return target of 575? I think the results here are pretty favorable. They don't change the downside scenario much. If anything, they make it like as you move out the spectrum, they actually make it a little bit better, the downside scenario, but it's pretty immaterial to me. To me, if we're talking a negative 4% year versus a negative 3.8% year over the 10 years, I mean, we're not talking large differences here. So to me, I want to make sure that when I'm putting together these recommended portfolios, I'm not introducing more, significantly more risk into the portfolio. I don't think any of these proposed portfolios do that. But what I do think that they do is they give us a little bit better chance. And you might just say 2% chance, like that's not a lot different than the current target, but it gives us a bit closer to a 50% chance of hitting that 575 return target goal over the next 10 years without adding risk to the downside. So that's how you would kind of read these two Monte Carlo outputs. So my recommendation, and would love to open it up for questions, get your all feedback, debate this more, but just to kind of end it on that before we talk about it is, my recommendation would be to move to portfolio 3. That's definitely the biggest move, but it's still only, it's really just taking a couple % out of US equity, moving it into international equity, a few % out of fixed income, moving it into DIS. So same managers we already have, just a slight shift in the target allocation. The rationale we've largely gone through already. I think this second bullet is probably the biggest rationale in my mind. If people were a little bit skittish, if you will, about wanting to rebalance into international equity, I think I would then say, well, let's leave the current target as it is, but let's still shift the 3% from fixed income into DIS. So maybe I'll end there. I know we went through a lot there, but please ask questions, and would love to hear your feedback.
Hey, Ian. Looking at your modeling there, you had 10 supposed portfolios there that, it creates. And it really seems to be, it loves the 15% in the GTAA and the 5% in the DIS for each portfolio. But under the proposed portfolios, you keep them pretty split. And is that just because you're trying to protect that downside risk in the future? Because this is striving for a return on these models? Yeah, I think this is where, you make a good point, and this is one where I think it's always a discussion of art versus science. So, I think you got to remember, the way I always think about it is, a model is only as good as the inputs that you give it.
So, I've run into this with lots of clients over the year where they say, why aren't we just picking one of these efficient portfolios? Like, why would we not just pick exactly what it tells us? And my response is always, there is error, obviously, in any forecasting number. And the second piece of it is there has to be some qualitative overlay to the process. To me, the thing that we're not getting here, we can't tell the model about, is our worries about the biggest risk that I think is somewhat poised to pension plans right now, which is some kind of runaway inflation or some kind of increased inflation that we weren't expecting. And that's something you really can't tell the model because, that's a scenario that could happen, is potentially we get some higher inflation going forward. You're going to get some of that protection from a GTA manager. The problem I have with loading up on GTAA is that, when we hire a U.S. equity manager, they can only invest in U.S. equity. When we hire international equity, fixed income, or this diversified inflation strategies managers, they've got pretty limited mandates. They can, even diversified inflation strategies manager, which has a bit more of a latitude, they really can only allocate to tips, commodities in a very small amount, some REITs, and some currency hedging programs. That's really all they have at their exposure. They can't wildly differentiate from that. A GTA manager can. A GTA manager really doesn't, it's kind of I don't want to say no rules, but they can make large allocation swings. So the more money of the trust we put into a GTA manager, the more trust you have to have in that manager, because that manager is making asset allocation decisions that then flow through to the trust. Maybe call me naive, contrarian, but I'm not a huge fan of handing over that much of the keys of the trust to a GTA manager. I don't mind doing it in increments up to about 10. I feel like that's kind of reasonable. You would want that much tactical protection. But the more allocation you give to a GTA manager, and these are things that the model doesn't know, right? We can't tell the model this, but the more allocation you give to a GTA manager, essentially the less control as trustees you're having over your total asset allocation, because you've now got a sleeve, a bigger and bigger sleeve that you can't control for. They might be really high on high yield bonds one year, or really high on this asset class, and they don't do well. And then you hand it over too much of the keys. So maybe I said too much, but that's usually my problem with loading up too much on tactical managers.
I was just struck by the consistency of the modeling. But thanks for your explanation. I think he did fill in the gaps there. I did see that Stephen had his hand up. I want to know if he still had a question because it looks like it went down. Stephen, did you have a question?
Thanks, Bill, but I'll hold for the time being. Thank you.
Okay. So going back to your recommendations page there, Ian, if you could scroll there. So you're recommending proposed portfolio 3, which was a very slight bias towards U.S. Domestic equities, and increasing our DIS up to 13%, I think it was, taking away from the bonds.
Yeah, maybe this is a better page to go to for right now. So this is the current target as outlined in the IPS. I would recommend we move to this. So the main shifts here are, you can see 31. So U.S. goes down 3, and actually maybe I'll go. I did outline them here. So really, these are the big changes: is U.S. equity down 3 to international equity, fixed income down 3 to DIS. But I completely would also be in favor of 1 or 2 if trustees felt, 3% is maybe too big of a move for us right now. Maybe we would consider another 1% in another year. If that was more palatable, then I would say, consider 2 or 1. But I would say that my recommendation would be to at least make some kind of movement in that direction in response to what we're seeing in the capital markets.
And Ian, if we did move to propose number 3 here, our bands would still be 5% either way on watching them run, or is it a 3? Would we reset the bands?
They probably remain the same window. I'd want to look at them to make sure that they still made sense. But given how small these moves are, I would assume that we would move our bands to have this proposed 3 be the new center of the bands in the policy. Good question. And you do that with any of these. If you chose 1, 2, or 3, we would shift the bands so that the new portfolio target allocation was in the center of those bands.
Well, I mean, I feel comfortable moving with your recommendation, and I'd put forward a motion to adopt proposed portfolio number 3.
I
don't know who's going to get credit for that second there.
It was John.
Okay. Any more discussion on this change?
No, I think it's a good change. Thank you, Bill.
Thank you, Christina. So seeing no hands and hearing no discussion, I'll do again, all those not in favor of this motion. Hearing none, then all those in favor?
Aye.
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 The motion passed unanimously. Thank you, Ian.
Thank you all. I will, I'm going to take a look after this meeting at where the allocation sits currently, and I will be in touch with Bill, Christina, AJ, all of you with my recommendation on how we move to that point. Do we want to do it in one swoop, or do we want to do a phased approach? I want to look at where the allocation sits as of the end of the market today, particularly because we have seen some movement in the markets. And then I'll email you all with an updated investment policy and my recommendation for how we actually transition to this new target.
I know usually we like to not do a one-time just because of timing issues and being sensitive to that. So I know in the past we split it up over like two moves, but.
And sorry, I missed the beginning of that. You cut out a little bit. Do you say?
I just know we've been sensitive on timing in the past, so we haven't done it in just one move.
Yep.
But we'll look forward to your recommendation.
Yeah, the only reason I would say doing it in one move is if for some reasons markets moved us enough in a direction where it was a modest shift, just a minimal shift, and it didn't make sense to split it into 2. I'm always trying to weigh the indirect versus direct costs, right? The indirect cost is differentiation between market timing. The direct cost is the trading implications. So we want to try to, minimize both to the extent that we can. The only time I'd probably say doing it in one swoop is if U.S. equity and international equity sold off in different amounts in the last couple of days to the extent where the movement wasn't actually that many dollars. And then we would it wouldn't make sense to spread it across 2 trades. But if it's generally larger than 1 or 2% total of the trust value, then yeah, I'd like to split it up into 2 times.
All right.
So
well,
thank you all very much. That's all I have today.
Sounds good. The next item on the agenda is the report of the actuary, and I will note that the report of the actuary is performed by Scott and Lacey, and not Dean and Sarah, but we'll save them for a later part of the agenda. So Scott and Lacey, you're up.
All right, Bill. We don't really have much formal to report here today. We're at sort of a quiet part of the 2-year cycle as far as what we prepare for the plan. Just wanted to note, sort of to piggyback off of some of Ian's comments, when it comes time for the next scheduled valuation towards the end of this year, the January 1, 2022 valuation work, we're going to be sort of circling back on some of the topics Ian covered today with forward-looking return and reflect the updated allocation and come to the trust at that time. So the 575, for example, that was mentioned in his presentation, that'll get a fresh look at the start of next year when that was selected, a little more than 12, 14 months ago at this time. At this point, that was, more in line with where forward-looking expectations were for all the reasons Ian just described. Not only RBKs, but other capital market outlooks are lower on a prospective basis, largely because things have bounced back the way they have in the last year. We're going to want to rebaseline all that before the next valuation, kind of early next year. So just to kind of tie in where we're at in the cycle and the discussion you just had with Ian. Lacey, anything else to add?
No, I think you covered all of it. Thanks, Scott.
Okay. So that's all we have today, Bill.
Ready for that conversation when that comes around. I know it's always kind of a tricky conversation because it does increase the per hour cost, but as long as we start seeding it early and we can start planning for it early, I think we can be successful. Okay, so no other questions for the actuaries? Seeing none, we'll move to the report of the attorney. And I'll just note that last pension trust meeting, we had some discussions from the Diversity Council here at LTD about plan loans and Roth 457 contributions. That work has been ongoing. We have met as a work group, and we've come up with a rough sketch of what we think it should look like. I have forwarded some of that conversation to our attorney, Jeff Kurtner, for review and input. So I was setting the table there for you, Jeff.
And what do you want me to address with regard to the loans and the Roth?
Yeah, so with regards to some questions I had was the plan document housing. So right now, the plan documents have been written up by Hirschner Hunter and kind of we keep those in-house. Some of the discussion coming out of the loans and Roth changes were moving our plan documents under VALIC and what the pros and cons of that move would be. I think just for the trustees' knowledge of what that might mean for future decision making and some of the risks that are there.
Yeah, so I think that one of the questions you raised in your email, and it's a good one, is do the trustees lose any control over the plan document if it moves out of sort of in-house document to a document provided, say, by VALIC? And I think probably the answer to that is no, you don't lose that control. You're very likely to be able to get the terms you want in the plan with a VALIC document, similar to what you would do with your in-house document or a document drafted by me. The likelihood is that you're not doing something so exotic that VALIC's document wouldn't be able to handle it. I think the only thing to consider moving to a document provided by VALIC as opposed to one in-house is that if for whatever reason you became dissatisfied with VALIC's service on its main function, which is investments, and wanted to move those investments, and you had VALIC plan document as well, then when you move to a different investment provider, you would also have to move your plan document. Whereas if it stays in-house, you don't need to do that move. And those moves can both be some expensive and they can introduce error. So I think those are the real considerations with regard to using VALIC as your document provider rather than doing it in-house.
Okay. Well, thanks for that review there, Jeff. Yeah, I just wanted to make sure we were having a total discussion on what these changes might make, because when we first were broached about the plan loans and the Roth, who controlled the documents or who housed them wasn't even on our mind. And then we got into a subcommittee group with VALIC, and it seemed like every other conversation they wanted to have was them housing the documents. And I was just curious on why they were so antsy to take over those. If it's just for an efficiency and they can provide better service if they house them, maybe that is a worthwhile venture.
I think from VALIC's perspective, it may be that it's easier for them to translate or transcribe or convert, however you want to look at it, the in-house document that they're not so familiar with to their document, which they are. So for them to provide their administrative or investment functions, whatever, using their document, that's easier for them. I don't think that it, unless they're in terms of money, I don't know that it really saves much for LTD, since you already have them embedded in as they're currently embedded. That's cheapest, so to speak. And so my guess is that the desire to make that move comes primarily from VALIC for VALIC's purposes. On the other hand, if VALIC is saying we will provide those plan documents at no cost, and if you're going to continue to use your in-house documents, then there is going to be an added cost, then LTD has a dog in the race, so to speak. But generally speaking, plan documents, there's only so many features that these plans have, and there's an infinite number of ways maybe that you can write them up, but they all pretty much do the same thing. So functionally, I don't think you're going to find much difference.
Okay. Otherwise, I didn't have any other questions regarding that process. If any of the other trustees had a question for Jeff, now's the time to talk.
I guess just chiming in one more thing, right now the summary plan descriptions are drafted by Milliman, and those would also presumably change to some extent, as would the internal plan documents. If you move to a VALIC plan, presumably VALIC would be providing a summary plan description, and so that summary plan description would also change to some extent. Mostly, I think the Milliman summary plan description would change by removing certain provisions from it, as would the current plans.
Okay. So I think what we'll end up doing is getting our subcommittee back together to move the process forward. So it's me, John Hampton, Stephen Yett, and then some staff from LTD has been participating in that. And so we'll get that on the calendar so we can keep this process going. I think it's been productive and looking forward to completing it. If we don't see any major red flags with changing plan document housing, then if it makes it easier on most folks involved, I think that is something we're pursuing as well. So I don't have any other questions for Jeff. I'll give it one more chance and then we'll move on.
I'm good.
I'm good.
All right. Well, sounds like Jeff, you're off the hook for now. Thanks for your input on that. I appreciate you reviewing some of that stuff in advance so you can answer those questions. And we'll move on to the report of the administrators with Sarah and Dean.
Thank you, Bill.
I did send out the reports to the trustees shortly before the meeting. And then just wanted to mention that nothing is out of the ordinary. It looks like there are more and more retirees each year. Of course, it's kind of expected, but none of the expenses are out of the ordinary. They're all monthly typical expenses or yearly typical. And I will open that for any questions.
Do you mind if I tease you, Sarah?
Sure.
You must be confusing this particular client with one of your much larger clients because you named the cash flow document hourly cash flow. And I did not know that we had such massive cash flows by the hour.
Well, I will name it ATU next time.
Yeah, I think because most all ATU members are paid by the hour. I think that is the what she's going for there.
Well, I think it actually is just an internal thing.
And we called the other pension plan the salaried plan. So I mean, I'm going to defend you, Sarah.
Thank you.
Okay,
Sarah,
so
do we need to make a transfer based on your document?
So on the cash flow analysis, I did one for each plan, and the ATU plan or hourly plan, I'm recommending that we transfer $300,000 to U.S. Bank for the investments. Right now, we're sitting on $1 million cash there, and we're paying out about $270,000 a month in distributions. The cash flow over the last year has been positive by about $40,000 a month. So if we transfer $300,000, that will bring it down to where it's slightly under sort of the 3-month target of distributions I like to keep in there, but based on the monthly cash flows, it will grow back to 3 months in there in the next couple months. So I would recommend that we transfer $300,000 to investments on the hourly plan.
that seems like a prudent time to bring that up because we're talking about moving some money around on the investment side. So a conversation with Ian, making sure it gets to where it needs to go.
Yeah, it may help Ian rebalance without having to move as much.
Yeah, but if I could just be appraised of the timing of when you expect that to hit the investment account, that would be great so that I can then know not to do my analysis in terms of how to allocate those funds according to the new target until we account for that. Certainly don't want to rebalance before that comes in.
Yeah.
Okay, I do think that might need a motion to approve that transfer. So I'll entertain a motion for approving that transfer.
I make a motion we approve the transfer to the bank.
Second.
It's been moved and seconded. Any more discussion on this action? Seeing none. All those not in favor. All those in favor? Aye.
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 Passed unanimously. Thank you. Any other things to report, Sarah and Dean?
So I have a cash flow analysis as well. I guess that goes for the next meeting though. So, so never mind. Yeah.
Yeah, just to let us know that you have that and we can get it on the agenda for the next meeting.
Yeah.
So that's a good thing. Also next meeting, I know we've been trying to get VALIC in here to do an annual report on our investment funds on the 401A side of things. They were unable to make this meeting and the last meeting. So hopefully, we can work with them, give them advance notice, and we can get them on a meeting where they can kind of bridge the gap between the ATU pension trust and the salaried pension trust. So we don't have to listen to them twice.
The only
Just-
other thing that I want to note is I will send out updated trustee meeting minutes for that error found at the beginning of the meeting.
Thank you, Sarah, for that. So we got new and unfinished business. There is a standing item on there. It is our 3% COLA work group. And that work group has seen some changes in it. And I think we need to get some other people up to speed on what we were actually looking to achieve there. So we'll work with LTD staff and management to restaff that group and hopefully come out with a recommendation on how to create a lasting COLA for our ATU members that have been retired. Now, this is just a recommendation. It will be brought forward into bargaining when we're all wearing different hats. We need to get that going again, and hopefully, as things stabilize here at Lane Transit District, we can reinvigorate that group and pick up hopefully where we left off. Other new and unfinished business. We have a new retiree in the ATU trustees. Mr. John Hampton has retired from active service at LTD, and he's staying on as a trustee for the time being. So I just want to congratulate John Hampton on his retirement and thank him for his continued service to the ATU Pension Trust. We will identify a replacement trustee in due time. But for now, John Hampton will continue to serve. But I just wanted to publicly wish him congratulations on his retirement.
Thanks, Bill.
Congratulations, John.
Congratulations.
Thank you.
Yes, congratulations, John. You've been an asset to ATU and LTD for many years, and we wish you the most happiness, and we're glad to hear that you're staying on for a while.
Yeah, I appreciate that. I've been learning a lot with being a trustee for the pension over the last few years, and continue to be very interested in how everything works and getting educated by all of you folks. And it's been a pleasure, and I hope to learn more yet and stay active with that. Thank you.
Okay, so barring any other new or unfinished business, I think we can move on to setting the date and time of the next meeting so we can play the Find Your Calendar game and get a recommendation from Ian when he thinks he can get all the facts and figures in for a report. I'm guessing sometime in August.
Yep, it would usually. So what are we today? May 11th. So yeah, probably, anytime after, August 10th or so is probably fair.
Twelfth works for me if it works for others. It's a Thursday. I can check the next week after that.
That works for me too, the 12th.
I can't do the 12th that week. Sorry.
Okay.
I'm open the 10th or 11th or 9th that week. I'm sure we could probably still do the 9th technically too. So anytime that week. Unfortunately.
For 11th, I'd rather avoid a Monday if I can, Ian.
Yeah. The 10th, I believe. I can do the 10th starting at 10:30 if that works.
You can do that as well.
That works.
You can do that as well.
My
the 19th?
Did I hear somebody ask about the 19th?
Yeah. Were we trying to do it before? It's just that following Thursday. We were keeping on.
I'm open the 19th also.
I can do the 19th. John Hampton, with your busy retiree calendar, how's that looking for you?
I think I'm free that day.
Okay.
The 19th.
Looks pretty good.
I have a hard stop on the 19th at what's that time? At 11:30. Which means that a problem for the salaried plan.
What was the other date that worked for everybody? I wasn't necessarily opposed to it.
August 10.
Yeah, if that works for everybody, that's fine.
I was hearing that LCOG, who does our streaming and recording, may have a problem on Tuesdays. So I was just going to check if the 19th work. I was wondering if we can do on 9 o'clock, maybe start. Let me go back to
Yeah, I could do early. I just have that hard stop at 11:30.
Well, being a retiree, getting up that early might be an issue, but I'll make it work.
We appreciate your dedication, John. Okay, so for one last time, see if we can get everybody to buy in. August 10th at 9 a.m. ATU Pension Trust with the salaried plan to happen thereafter.
Actually, I thought it was the 19th.
the
19th,
19th.
okay. All right.
Yeah, we're trying to stay
August
away
19th.
from Tuesdays. I think Camille's letting me know that LCOG, and I think Neil's on here. He may be able to tell us if all Tuesday is bad for him. If not, we could do the 19th at 9, starting at 9.
I'm just going to take the 19th at 9.
Okay,
Let's do it.
that works.
Okay. Well, that concludes our meeting for the ATU LTD Pension Trust. I thank everybody for their time this morning and their reports and being here and being involved in the process. You know, it's critical work for our active and retired members and future members. So, you know, I know we have a good team here. We've been doing good work, and hopefully we can keep it going.
Thank you.
Thank you, Bill, and everybody's participation.
Thanks, everybody.
Have fun at your next one.
Thanks, Bill.
Thank you.
Thanks.
Thanks, John and John.
AJ, are we staying on this one for the next? Okay.
Yes. We'll just stay right here. We only move if we have an executive session that we don't allow members of the public, but this is just a continuance.
Okay.
Right. So I'll start the LTD Board Pension Trust for the salaried plan. I have up the agenda, and I'll start with a roll call. I'm here, and I think Stephen's here, and AJ.
Present.
Correct. Present. Thank you.
Thank you. We will have any audience participation. Camille, is there anybody who's waiting to speak? I'm assuming there's no public comment.
I apologize. I was double muted and I didn't see that. There is no one wishing to speak. Thank you.
Thank you, Camille. So the items that we have for the agenda today are the typical ones, so approval of the meeting minutes. Then we have the investment, the actuary, the attorney, the administrator. And is there anything else that people wanted to have on this agenda today? Okay. Has everybody had a chance to review the minutes from the last meeting? And does anybody have any changes?
I just want to check that. I'm going to open up my minutes again, see if the change that Stephen requested for the other one was also made on this one.
Yeah, it was correct in the salaried one. It just was incorrect in the
Correct.
Yeah, so I didn't catch that. So, okay, if it is, then I move to adopt minutes.
Second.
Great. So anybody who is not approved? All right, all in favor? Aye.
Aye.
All right. Stephen?
Aye.
All right, great. Passes the minutes. So moving on to, there are no items for board recommendation. items for the investment consultant. Are there any changes, Ian, that from what you presented or things that you want to present? Probably your asset allocation or any of your performance changes for the admin plan versus the ATU plan?
I would say that the performance comments we probably don't need to cover again, as that is largely the same, but I would like to go over the asset allocation.
Okay, thank you.
All right. Hold on just a second. Let me get my screen up. All right. Okay, so I'll be a little bit more brief with this one since we went through most of the background information, but I did have, and this is the first time that we've encountered this in a while, but I did have a recommendation for a change to the salary target allocation that is different than ATU. A little background on this. I know, Milligan gave you guys some great information on this last time about potentially thinking about when we were going to start down the road of possibly de-risking this plan. I know for a number of years we've talked about this, and we have talked about potentially doing it following some really strong investment returns, which we have seen and have exhibited and have materialized into improved health for the trust. And given where this plan sits in terms of cash flow needs going forward, obviously in a different situation than ATU, we're approaching some larger negative cash flow implications. We do have a slightly lower investment return target for a whole host of these reasons. I would not like to add any risk to the plan in terms of trying to pursue higher expected returns. I think for this plan, I look at it more like I would like to reduce risk if I can, while trying to maintain some similar level of probability of achieving the 5.5% return target. So because of that, and we'll go into a little bit more of this as we work our way through the deck, same inputs to the model, same assumptions here, but I've outlined two proposed portfolios here that do similar themes to ATU in terms of modestly rebalancing from U.S. equity to international equity, and also modestly increasing diversified inflation strategies. The difference here is I've gone about this in two different ways that I'll outline for you and give you my recommended structure. The proposed one does this shift by simply reducing U.S. equity, keeping international equity the same. So obviously the mix here will naturally get us more toward a more balanced U.S. versus international portfolio, but not as much as ATU. I'd still international equity is still slightly riskier than U.S. equity, even though it does have higher expected forward-looking returns. I still think having a little bit more of a U.S. equity footprint makes more sense in this plan. So I haven't closed that gap as much as you will. It's the ATU plan, if you will. And the second component is I really don't want to draw down fixed income too much or if any at all, as that really is our largest diversifier in the plan and our largest protector of equity drawdowns. While yields don't look great, we can't escape the yield environment that we're in. I'd rather have this increase in diversified inflation strategies come from the equity portfolio as opposed to the fixed income portfolio. So the second way I've potentially gone about this is if the trustees wanted to keep total equity exposure the same as the current target, so kind of keep risk levels a little bit more, or the expected return a little bit more elevated than drawing into diversified inflation strategies from GTAA. My suggested route is given how we've voiced over the years the potential to find opportunities to de-risk the plan. I think this is a pretty great entry point into moving toward that direction. And I would propose doing that through this proposed one scenario. So that is keeping fixed income the same, keeping GTA the same, keeping international equity the same. So the only movement here is taking 3% out of US equity and moving it into diversified inflation strategies. So here you'll notice instead of moving up into the right, we're moving slightly down into the left. So what does that do from a modeling perspective? Here it gives us a still identical opportunity of, or a probability of hitting our return target of 5.5. Can you all see my cursor? Does that show up when I, perfect. So the 42% here, it doesn't increase the probability of hitting it, but it keeps it the same. But what it does here is it materially, I think 50 basis points is a material betterment in terms of downside risk protection. So this is the kind of over the 10-year period, what the worst case outcome would be over a 10-year span. It reduces it quite meaningfully at 50 basis points less of a downside risk. So instead of the fund experiencing about a negative 4% over a 10-year in the worst case outcome per our modeling, it's only down 3.5. And so my recommendation would be to take this opportunity in time that we're given here, given the characteristics, demographics, the different unique things that are associated with this plan, and take this opportunity to de-risk slightly, and do that by moving from U.S. equities into diversified inflation strategies, because it does reduce total overall risk. Two, it does give us a little bit more balanced U.S. versus international footprint without having to even touch international equity, just by simply moving domestic equity into diversified inflation strategies. It gives us the same increased inflation protection that we talked about in ATU. And it gives us a similar probability of hitting our return objective of 5.5. I've included a couple additional pages here, just given the negative cash flow situation that we're situated with the salary plan. So what I've done here is I've modeled forward-looking 10-year, and we've done this in the past for this plan, 10-year looks based on each target at different percentiles. So, I've mapped 75th, the median outcome, the 25th percentile, and the first percentile. So first percentile obviously being the worst. And what I want to see between current target and proposed one, what you do here is you see a very similar median outcome. If you flip back and forth between the pages, you actually see a slight increase with proposed one, but marginal, pretty similar. But you see a meaningful kind of betterment, if you will, to the worst case outcome. You do see, I will point out, you do see a pretty notable also decrease in the kind of best case scenarios. In my opinion, that's the last thing I want to try to optimize, is the best case scenario. I think we should never count on getting that. What we should try to optimize is median outcomes and worst case scenarios. And what moving to current from this to the proposed target does is it gives us a very similar median outcome, but it gives us a materially better worst outcome, which is important for a plan that is as mature as this plan is and has the cash flow needs associated with it. So maybe I'll stop there. I know that was quicker than ATU. Happy to go into this more, but that would be my recommendation, is to take this opportunity to slightly move into a less risky asset allocation. This will obviously shift this plan away from ATU moving forward in terms of its performance. So, you know, some things to keep in mind is if we have a really strong next 10 years, for example, ATU is likely to do better, for sure. I mean, it's got a heavier equity footprint, but it had the cash flow situation that it's in. Heard, you know, Dean's comments that we just discussed. It's in a situation where we're able to continually push money into the investment program. The salary plan is in the exact opposite situation. We're going to be in a situation, you know, at some point where we're going to need to start drawing down from this plan to be able to make benefit payments. So I think that this is a scenario or a point in time, particularly given the last year of returns up about 40-some% for the trust, that would be opportune to make this move. And I would love to open the floor up to Scott as well, if he'd like to have any comments to dovetail onto this, or Lacey, but that would be my recommendation.
I think all I would have to add is I think I can see where Ian's coming from, and I think his points make sense. I guess I would characterize this as it sounds like a pretty modest step towards narrowing that sort of cone of uncertainty over the next, 5, 10, 15 years, which seems prudent from our perspective.
Christina, can I chime in for a second?
Stephen. Yes, please.
Yeah, I don't mean to step on protocol here, and I don't know if this is allowed, but I just want to point out that Carol James has her hands up in the audience. I don't know how we should handle that, but I just want her to be recognized.
Well, we normally had public comment at the beginning, Stephen, so at this point, I want to just go through the discussion that we have with regards to asset allocation among the trustees.
Okay, again, I don't want to step on protocol, but I just want that to be recognized.
Thank you.
And just pivoting to Ian's comments and also Scott's, I agree with this approach. And obviously, this plan is a different animal, as Ian pointed out, than the ATU one, and that necessitates a different approach to how we manage the funds going forward. And I think this makes sense.
Thank you. I have a quick question, a couple quick questions. One question I had is, what is the level? So Ian, you showed us the different levels that would occur depending on, what the risk factors were. What is it that we need to have for the plan to be 100% covered in the 10-year period?
What would the plan value need to be?
Yeah, so you showed, anywhere from about 9 million up to like 37 million, right? So, I'm curious where within there we have to hit in order to be 100% funded.
Yeah, maybe I'll let Scott chime in on that? Because it does change obviously every year that you move through, you know, your benefit payment schedule. But Scott, I don't know if you have a more exact answer to that from an actuarial perspective.
No, that's a good question. I don't think we've got a specific answer to tie it to this projection for a couple of reasons. One is that's not one that we've prepared yet at this time, and it also would update depending on the current 5.5% assumption when this gets looked at later, towards the end of this year. If that comes down at all based on some of the inputs we've seen here, then that remarks the funded status measurement and would change it a little bit. I guess the key point I'd want to point out here is that my understanding of what Ian is showing here, I think this reflects cash flows that we provided for him for this purpose, but I think those are based off of a single scenario sort of median. I don't believe we provided anything that would have reflected the dynamic that in this first percentile return, in reality, if you were experiencing that, the actual contribution would get ramped up with each valuation as it recognized the past losses. So this, the message would be the same between these, but it would be a narrower cone. Like I think the importance of this demonstration that he's doing is comparing this slide to the next one, more so than the specific dollar amount at year 10, because this is kind of with a blinders on as far as assuming the contribution policy doesn't react the way that it would over this 10-year period. So Ian, am I characterizing that correctly?
No, that's a great extra point that I should have made. What we're doing here is trying to take, estimated cash flows year by year and apply that to the different asset allocations, but it in no way can be as dynamic as Scott is mentioning, which is to say, if you were to experience that green line, for example, that first percentile, then obviously the contributions that would be needed from the system would be completely different than if we're actually hitting our 5.5% every year. Correspondingly, this doesn't account for any changes in asset allocation across the 10 years. If you were to experience the 75th percentile line, for example, well, you de-risk it, you continue to de-risk it, right? If you experienced amazing returns over the next 5 years and we got to a funded status that was near close to 100%, then obviously we wouldn't maintain this asset allocation, and we might make differences if the opposite was true. So it can account for things like that, but I think Scott makes a great point. The point I'd like to make is the distribution between the cones when you look at these two pages, just in isolation, to say our range of uncertainty narrows with moving to proposed target 1, while still maintaining the median outcome at a very similar level. And to me, for a plan that is like this, that has the challenges associated with it, that makes sense from a risk perspective. But Scott makes a great point for the other variables.
Thank you. I see AJ also has her hand up.
I think you guys answered my question. I was thinking along the same lines as Christina, but I understand that this doesn't solve everything. I mean, it looks a lot more promising, and I'm supportive of this recommendation, but I think I had similar questions as Christina, so I get it.
And Ian, I have
just one more thing to close the loop on that I think we'd left after our last discussion for this this group was sort of around risk metrics and evolution of the plan. I think we left as a potential next step whenever the trustees wanted. We could do a more in-depth projection that does reflect some of those changing dynamics over a 10-year or 15-year horizon for a future meeting. And I think just let us know. You would see some of these same things, but it would reflect the stuff that, or the element that, like the green line there, would flatten and increase as more contributions come in responsive to the policy. So that's a future item we can prepare, with some notice. whenever it's helpful.
Thank you. And Ian,
also, so I'm sorry.
Go ahead.
No, please go, Christina.
So the other question I had is you chose a 3-point reduction on the U.S. equity, and that makes, I understand based on your previous presentation, why we would move out. But I'm curious, why 3 and not more? Why would you not lock in more of the, because you talked about the, how much gain there has been, and how do you pick 3 versus 4, and how does that change the risk? Because from where we are, for where you show in scenario 1 to potentially some other future scenario. So
I would say that you could always move more. This is kind of the tipping point where it still keeps this probability pretty similar at hitting the 5.5. We're still not even at 50% chance of hitting it. To get 50% chance of hitting it, we would have to add equities, and we can't do that, right? That's not a prudent thing to do. On the flip side of that, if we were to reduce more than like about 3% out of equities, this number starts to drop. This number will continue to get better for sure. This will start to look better for sure, but then now we're at the tipping point here. So I thought it would be a prudent first step, since this is our kind of first trip down the de-risking. I know we've been having this conversation for as long as I've been with you. We've contemplated it. This is the first time that I think that we're that we are we're coming out of a positive situation that gives us the opportunity to do this prudently. But if you all would like to do this more aggressively, you certainly can. It just is going to diminish the risk. Diminish the potential to hit 5.5 going forward. So the only thing I have to go on is to assume that 5.5 is your investment return objective. If you were to tell me that the district was going to reduce that to drastically lower than 5.5, then I think that, you would have room to move more out of equities. But assuming that 5.5 is where it's going to remain for at least the time being, I think this is a prudent first step. But we could be having this discussion next May. And if the situation has changed and we're coming off another very strong investment return year, which, fingers crossed that we do, then I think that there might be some opportunity to continue de-risking.
Yep, I like how you've reduced our risk and increased our or at least kept the probability of the target being the same. So
yeah, that was my goal, was to try to bring you an allocation that solved two things kind of at the same time. It didn't hinder your ability to meet your return objective, but it trimmed some of the downside off.
Awesome. Does anybody else have comments or further discussion? If not, I will entertain a motion.
I'm happy to make the motion. I just want to make sure that the stated motion is correct. Ian, can you help us with the exact recommendation so we can ensure that it's very clear?
Yeah, I would just say that if you recommend or you approve the recommendation to move to proposed portfolio number 1 as outlined in the presentation.
So I make the motion to move to propose portfolio number 1 as outlined in today's presentation.
Second.
All in favor? Aye.
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 Motion passes. Okay, so I believe that the next item on the agenda is a report of the actuary. So,
Thanks, Christina. And we really don't have any particular material to cover today. Happy to answer any questions if there's anything that's helpful, but we'll start to have more agenda meetings to some extent in August, but then I think in November when we get into more of the weight of the work for the July 1 valuation, we'll come back with assumption discussion, both related to the discount rate that we've sort of been touching on today, but also other things like mortality table, mortality assumptions and things of those nature. So that's sort of preview of coming attractions.
sounds good. Thank you. All right. The next is the report of the attorney. Do you have anything, Jeff, that you wanted to share?
I do not.
All right. Sarah, do you want to go over the administrator's report?
You're muted.
You're on mute, Sarah.
You're muted.
Okay, there we go. Sorry. So all the expenses are very typical of this time of year. They're all monthly expenses. Nothing really to report other than the upcoming retirements, and those are typical for this year. And since we're doing all of those lump sum retirements for the age 60 people, other than that, any questions or? Okay. Dean, you want to take over?
So on the cash flow on this plan, we're recommending a transfer in the other direction from the investment accounts to checking of $100,000. Right now, checking currently has $273,000, and we're paying out about $145,000 each month in distribution. So it doesn't have our sort of comfortable 3 times distributions sitting there. If we just look at what's happened the last 12 months, our outflow is negative by about $13,000 a month. But we had 3 months of distributions where we had some really big distributions where we had those people we paid retroactive benefits to. So if I figure what our average monthly outflow is and exclude those ones, it is positive by about $13,000 a month. So it's right about break even. It's not real high one way or the other. And so I think if it actually plays out to be positive by $13,000 a month over this next year, putting $100,000 into the checking right now gives us kind of the cushion we need for making sure we never have a payroll that ends up with a bounce check.
Thank you. Any questions?
I do just have a question. And the recommendation here is just for that one time, and
yes.
You feel that will be sufficient over.
So I think if cash flows carry forward as I project they will, that it will be a year before we need to revisit it.
Okay, that was my question. Thank you for that.
Dean, is there a timing on when you definitely need this by? Just so, because similar to ATU,
right?
But if the roles are reversed now, I think I should do my coordination of what the rebalancing would look like to get to the new target and incorporate the 100,000 coming out. So I just want to make sure I'm sensitive to the timing.
Yeah, no, we're not in danger of not covering a payroll or anything like that right now. So I think you can do your calculations and tell us when you've got them done and are ready, and we can do the transfer at that time.
Okay, sounds good. I will make sure to touch base then with you and Sarah, and included in the directive that AJ and Christina will sign to move the assets within the investment trust. We can then also put into that the 100,000 moving over to the checking.
Okay.
Perfect.
And it was 100,000, correct?
Right. Okay. Yeah.
Do we need a motion to move the 100,000?
Would you like to make a motion, Stephen?
I make that motion.
I'll second that.
All right. All in favor, aye.
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 Okay, motion passes. Thank you.
That's all we have.
That's all you have. All right. Are there any future agenda items that this committee would like to make sure get on the agendas for the next meeting? Okay, so the next meeting is scheduled for August 19th, following the ATU meeting that starts at 9 a.m. And thank you very much, everyone. I appreciate all your time and information and attention, and have a great rest of your day.
Thank you, everybody.
Thank you.
Thank you.
Thanks, Christina.
Bye. Thanks.